Hello, in this lecture we're going to continue on our short test type problems. These are going to be shorter problems that can be used in terms of studying for a test because they will be in the format that is short. They can be made into multiple choice type questions. We'll look at how to approach these. So here we got the next one. Company purchased $8,700 worth of supplies and paid cash immediately. Which of the following journal entries will record this transaction? So once again, I'm going to pull this over to the left-hand side and look at a trial balance. This is an unrelated trial balance, but it's good to practice at least with a trial balance. It'll tell you assets, liabilities, equity. It's going to be in that order. It can tell you what types of accounts are debit and credit accounts. So when you're practicing, good to have it available. If you can have it available during the test, good to have it available. All right, so company purchased $8,700 of supplies. Pretty straightforward journal entry. First, I usually ask, is cash affected? Because that's going to be the easiest one to see which way it will go. In this case, yes, it is affected. We purchased it and paid cash immediately. Therefore, cash is going to go down. Cash has a debit balance represented by the fact that it has no brackets. To make something go down, we do the opposite thing to it. Therefore, we're going to credit cash. So I'm going to credit cash and just write out the journal entry. So the debit and the credit. And what did we get? Supplies. Now, the tricky thing about supplies is that it could be supplies asset, could be supplies expense. Usually when we buy the supplies, it's going to be a supplies asset, and we're going to treat it in a similar way that we might treat like inventory, meaning we're going to buy it, then we're going to expense it when we use it. In supplies case, when we consume the supplies or use it in the course of business. In the case of inventory, when we sell it in the form of cost of goods sold. So the debit is going to go to supplies. Supplies is an asset. It's going to make the asset go up. So we're going to have a supply on the debit side, and of course the debit will be for 8.7. And the credit will be for 8.7. I'm going to put a negative. You don't have to. Now remember, the question could ask for an entire journal entry and give you the entire journal entry in a multiple choice format. It could ask for just one half of it. It could say, hey, what would the journal entry do? Would it debit supplies or would it credit supplies? Would it debit cash or would it credit cash? And note that that is confusing, more confusing, because you could get the debits and credits mixed up. If you draw out the journal entry before looking at the multiple choice question answers, then you're more likely not to go get mixed up on the debits and the credits. Next one says that at the end of the first month of operation, company reported net income of $28,600. They also had account balances of cash $20,004, supplies $2,006, and accounts receivable $11,200. The owner's total investment for the first month was $5,006. We want to calculate the ending balance in owner's capital account to be reported on the statement of owner's equity. So if we think about how we're going to calculate that, we could look at our trial balance and say, what's in owner's equity? It's going to be the starting balance, which is usually what's in there on the trial balance, plus net income, which is going to be the revenue minus the expenses, less the draws. So we can think of that. It's going to be the beginning balance in the capital account plus the activity, which is usually going to be the net income, the income statement, which is revenue minus expenses, less the draws. So let's see if we can put that into a plus and minus format. If we had capital beginning is going to be what? And they didn't tell us, well, hey, this is what we started with. Well, we're assuming, of course, we started with 0 because they're saying it's the first month of operations. And then there was an investment. So this is basically where we're starting. We're starting where the investment happened, where $5,006 was put into the business. Hopefully the owner's not going to be investing all the time. The owner should be drawing money out. If the owner does invest, that will usually be in this beginning capital number on a trial balance. That will consist of the prior balance from last month or last year, plus any investments. So that's what will be in there. And again, investment shouldn't be there, hopefully, too often in every month, because the money should be going the other way after a while, hopefully. All right, and then we say that we have net income, which is the whole income statement in one number, revenue minus expenses, and that's $28,600. That, remember, is going to increase the equity. Why? Because net income is part of equity. Net income rolls out into the capital account at the end. And then they give us a lot of other information here. They give us the other balances of cash, office supplies, accounts receivable. Those are somewhat irrelevant, hopefully, in this problem, so they give us more information than we really need. What would the other piece of information that would be relevant is if there were draws. Looks like there were none on the first month here. So we would have the beginning balance plus the investment plus net income. 5.6 plus the 28.6 gives us the 34.2. And again, the thing that makes this one difficult is that they gave us more information that we need. We had to peel off some information that is not needed that they gave us within the problem. All right, next one, a bit longer. We got the company opened on January 1st of the current year. During January, the following transactions occurred and were recorded in the company's books. I'm going to skip this and go down to the end. I'm not going to read all the transactions. I suggest doing this in a multiple choice question, and I'm going to see what the goal is and then go back and read the transactions. So the goal, based on this information, capital account reported on the statement of equity at the end of the month. So they give us the beginning equity account. We need to get the ending capital account. So we can think of that basically as a T account. We can think about it as total equity or the ending capital account. That's going to be basically our T account. And what we're doing really is you look at the trial balance. We're basically kind of saying this whole section right here, let's think of that as like one big T account. And similar to just the equity section, equity piece of the accounting equation, assets equal liabilities plus equity, everything within equity, when we think about the accounting equation, are all these accounts here. So we're just going to think of that in terms of debits and credits. So we're going to have our debit and credit. And anytime something happens to owner capital, draws, income summaries, a clearing, it won't be there relevant because that's a closing account. And then revenue and expenses. Anytime we see those, then we're going to affect our T account. I'm going to make it look like a T's here. So we're going to have our center those, and we'll underline those, and we'll make this look like a T with another line here. So we have our T looking account, which is similar to a GL account. Again, there is no GL account for the entire equity, but we're treating this as if it was just one big one account, one GL account, the equity section. All right, so let's take a look at it then. Owner invested $15,000 cash in the business. Let's think about the journal entry. Is equity affected? Well, I usually ask, is cash affected? Cash is affected. Cash would be debited because it's going up, and therefore we're going to have to credit something. Who put the cash in there? The owner, the equity account. So the capital account is going up in the credit direction. So we have a credit here. It's going up. We're going to do the same thing to it in this case, which would be another credit. I'm going to represent credits with a negative number. Remember, that means credit, not negative, not a minus in this case. Number two, owner contributed $35,000 of photography equipment to the business. So again, is cash affected in this case? No, because you put in photography equipment, no cash affected. There is equipment affected, and we can see here if you have the trial balance, you can see, well, equipment's an asset. Assets have a debit balance. We got more of it. It's going to go up. Therefore, we're going to debit the equipment. What are we going to credit? We're going to credit the capital account. The owner put the equipment in. Therefore, the owner is owed back. Capital has a credit balance. We're going to make it go up by doing the same thing to it, which in this case would be another credit. So I'm going to put a negative $35,000 in our T account for this. We're only recording the credit portion in this case to do it a little bit more quickly. And then number three, and we might want to highlight these as we go or mark them off, check them off if you're doing a paper test, obviously. And we're on number three, where the company paid $3,006 cash for an insurance policy covering the next 24 months. All right, so is cash affected? Yeah, we paid cash. Cash is a debit balance. We're going to make it go down because we paid it. So we're going to credit cash, and then we're going to debit something. What will that debit go to? Well, it's either going to be insurance expense or prepaid insurance. In this case, it would be prepaid insurance. But either way, well, in this case, it's prepaid insurance, which is not part of the equity account here. So that's something to be careful of. Remember that insurance, by definition, we pay for it before we use it. So that one is not affecting the expense and therefore is not part of our equity section. So we're just going to say not part of. I'm just going to say that one's done. Next one, the company received $7,200 cash for services provided during January. So is cash affected? Yeah, we received it. Keyword, received cash. And so it's going to go up. So we're going to debit cash. Cash is a debit balance. We're going to make it go up by doing the same thing, which is another debit. Then we're going to have to credit something. And the question is, did we do the work today? That's when we would earn revenue. And the answer is, yeah, they're saying that we did it this month. So basically, we earned the revenue in this month. Therefore, under the revenue recognition principle, we can increase revenue. Revenue has a credit balance. It goes up by doing the same thing to it, just like anything else, which is another credit. And so it's part of equity because it's going to close out to equity. It's part of the equity section. You can think of it as a closing entry. It closes out to equity. You can think of it as all of these accounts are all basically equity income and the equity section of the balance sheet, just like in the accounting equation. You can think of the equity section of the statement of owner's equity, and note that equity is calculated as beginning equity plus net income. All right, so then we're going to say that net income is going to increase it by a credit of 7.2. So there we have that. And next one says company purchased 7.7 of office equipment on credit. So is cash affected? Yep, cash is going down. I'm sorry, on credit, cash is not affected. So it's going to go into accounts payable instead. We paid it on credit. So then I think about what did we get? We got equipment. Equipment is an asset. Asset went up, we got more of it. We're going to debit equipment. We're going to credit not cash, but accounts payable increase in the liability. So equipment and accounts payable. Note that neither one of those are down here in the equity section. So therefore no effect on the equity section. Tricky part being here then that the equipment is not an expense. It's not equipment expense. We're going to capitalize it and then depreciate it. That's why it's not affecting the income statement yet. No effect, so we'll just highlight that and say no effect again. Next one says the company provided $4,250 of services to customers on account. All right, so is cash affected? In this case, no. Why not? Because it says on account. And on account means that we did work and we didn't get money. It usually means in literal terms of accounts, it means either accounts receivable or accounts payable. And in this case, it means accounts receivable. We didn't get cash, we got an IOU. The IOU is the receivable, still an asset, not as good as cash, but still an asset. It's still going up. Cash has a debit balance. The receivable has a debit balance. We're going to make it go up by doing the same thing to it, which is another debit. So we will debit the receivable. And then we're going to credit what? Even though we didn't get the cash, we did the work. And therefore, under the revenue recognition principle, we credit revenue. Revenue is being credited. We earned it. Even though we didn't get paid, that is the point in which we recognize revenue under the revenue recognition principle. Has a credit balance. We're going to make it go up by doing the same thing to it, which is another credit. So that is part of the equity section, credit 4250 here. That one's done. We've completed that one. Next one says company paid cash of $3,000 for monthly rent. All right, so is cash affected? Yep, we paid cash. Keyword paid cash. So there, well, it didn't say cash. It does say cash. Paid cash. All right, so cash is going down. Cash has a debit balance. We're going to make it go down by doing the opposite thing to it, which is a credit. So we're going to credit cash, and then we're going to debit. What did we pay? Rent. And we usually hear the rent. We usually say rent expense. Rent expense. It's going to be down here. I don't have a rent expense in this example, but we can see that the expenses are down here. We can see the expenses have debit balances. We can see that they only go one way generally. They go up with a debit. So we're going to have to debit rent expense. Now we debit rent expense because we consumed the rent, not necessarily because we paid it at this time period. But that's for another time. So rent expense is part of the amount that will be closed out to capital. So we're going to say debit $3,000. Finally, we have a debit in our T account here. You would think we'd have more debits. There's usually a lot of expenses. So the company paid $4,006 of the office equipment purchased in transaction 5. All right, so we paid off some of the office equipment now. So remember, we bought that office equipment on credit, so it was like in account payable. Now we paid it. So we paid it with cash, assumedly. So it's cash affected? Yes. Cash is going down, keyword paid. Cash has a debit. We're going to make it go down with a credit. So we're going to credit cash, and then we're going to debit something. And we're not going to debit the equipment. We're going to debit the payable. The payable's got to go down. It's in the payable because we bought it on account last time. Now we're like paying down the credit, and it's going down. Now, note what's not affected. Anything in this equity section with that journal entry. Therefore, no effect on our T account. And we can move on to the last one, which said paid $425 cash for January utilities. All right, is cash affected? Yes, it's going down. Paid, keyword. Cash is a debit balance going down by doing the opposite thing to it, which in this case would be a credit. We're going to credit cash. Therefore, what are we going to debit? Utilities expense. Well, that's usually what we hear on utilities. utilities expense is an expense. Expense is going to be debited, and the expense is part of our equity section. Therefore, we're going to debit the utilities expense of $425. So then we can add up both sides of our T account equals the sum of, I'm just adding up 3,000 plus 420. That gives us 3,425. Then we're going to add up the credit side. I'm just going to add up. These are credits, but it's 15 plus the 35 plus the 72 plus the 4,250. And I'm going to go all the way down, even though there's blank cells. That gives us the 6,145. Now the credits are going to win. The 6,145 minus or plus, plus the negative is the 3,425 plus the negative. And that gives us the credits winning by 58.25.